The average investor underperforms the S&P 500 by over 3% annually over a 30-year period. Why? Because most people panic sell during market crashes, precisely when savvy investors start buying. I once watched my portfolio drop 40% during the 2008 financial crisis. Instead of selling, I studied Buffett's approach and turned that market collapse into my greatest investing opportunity. Today, I'm revealing 4 psychological and strategic moves that transform market fear into profit. After watching this video, you'll know exactly how to prepare for the next market drop and join the select investors who capitalize on downturns rather than becoming victims of market psychology. The psychology behind Buffett's calm during market chaos. So what exactly happens in Warren Buffett's brain when the market plunges 30% and everyone else is losing their minds? While most investors are panic selling their portfolios and checking stock prices every 5 minutes, Buffett sits back with an almost eerie calm, sometimes even smiling. What's his secret psychological advantage? Let's be real. During market crashes, most of us get hit with a tsunami of emotions. Your heart races, palms get sweaty, and suddenly that retirement account you've been building for years feels like it's evaporating before your eyes. This is your brain's ancient fight or flight response kicking into high gear. Your amygdala hijacks your rational thinking, and boom, you're panic selling at the worst possible moment. But Buffett? His brain operates completely differently during these crisis moments. While everyone else sees disaster, he sees the investing equivalent of a Black Friday sale. He experiences those same biological fear responses as the rest of us. He's just trained himself to override them with a psychological framework that completely flips the script on market downturns. That famous Buffett quote about being fearful when others are greedy and greedy when others are fearful is his actual operating system. The mental framework he uses to make decisions when markets go haywire. And his secret psychological advantage might surprise you. It's his temperament. Buffett himself has said that temperament is more important than IQ when it comes to investing. The Oracle of Omaha believes that managing your emotions is more valuable than being a mathematical genius. He spent decades training himself to resist those primal stress responses that cloud judgment when stocks are tanking. While other investors are driven by panic, Buffett maintains what psychologists call emotional equilibrium, the ability to stay balanced when everything around you is chaotic. One of his most powerful mental techniques? Buffett fundamentally reframes what a stock actually is. While most of us see stocks as ticker symbols, fluctuating prices, and green or red colors on a screen, Buffett sees partial ownership in actual businesses with real value. This completely changes his emotional reaction to price drops. When you see Apple down 25%, your brain registers it as a loss. When Buffett sees the same thing, he's thinking, Apple, the company that makes products used by billions, is now available at a 25% discount. That reframing creates a totally different emotional response. It's exactly like walking into your favorite store and seeing everything marked down 30 to 50%. Most people feel excitement, not panic, when they see sales. That's precisely what happens in Buffett's brain during market crashes. He actually gets a dopamine hit, the brain's reward chemical, when he sees quality businesses available at discount prices. There's another key element to Buffett's psychological advantage: expectation management. Most investors are emotionally devastated by market crashes because they're surprised by them. Buffett, however, expects and prepares for them. He knows market history shows that significant downturns happen regularly. By accepting this as normal rather than exceptional, he removes the shock factor that triggers panic in other investors. Picture going on a boat ride. If you're surprised by a huge wave, you'll probably freak out. But if you're expecting waves and have prepared for them, you'll stay much calmer when they hit. That's what Buffett does with market volatility. He's not surprised by 30% drops because he knows they'll happen eventually. This expectation management creates a psychological buffer that protects him from emotional decision-making. Buffett also employs what psychologists call cognitive reappraisal, the ability to reinterpret an emotional situation in a way that changes your response to it. When markets crash, most investors think, "I'm losing money. This is terrible." Buffett reappraises the same situation as, "Businesses I understand are now on sale. This is an opportunity." Same external circumstances, completely different internal response. This explains why Buffett can maintain his legendary patience during turbulent markets. while others are. Desperate to take action to stop the pain of losses, Buffett has trained himself to separate the emotional experience from the decision-making process. He follows a disciplined, rational approach regardless of what the market is doing. Something that sounds simple, but is incredibly difficult for most humans to actually do. Buffett limits his exposure to market noise that might trigger emotional responses. He famously avoids watching the stock market ticker throughout the day and doesn't have a computer on his desk. By limiting the inputs that could trigger fear responses, he protects his rational decision-making ability. Studies have shown that investors who check their portfolios daily during crashes experience significantly more stress than those who check weekly or monthly, even though the actual financial outcome is identical. Buffett instinctively understands this and protects his mental state accordingly. Another key aspect of Buffett's psychological advantage is his long-term perspective. While most investors worry about next week or next month, Buffett thinks in decades. This time horizon shift fundamentally changes how your brain processes market volatility. If you're focused on a 20-year horizon, a one-year market crash becomes a tiny blip rather than a catastrophe. Perhaps most importantly, Buffett has built a psychological feedback loop from his past experiences. Each time he successfully navigated a market downturn and come out ahead by buying quality companies at discount prices, it reinforces his confidence in the approach. This creates a virtuous cycle where each crisis he weathers makes him even calmer during the next one. He has decades of personal experience proving his approach works. Buffett's rule number 1, never lose money, and how he actually applies it. Those decades of experience have crystallized into Buffett's most famous investing principle. But there's a massive disconnect between how most investors interpret never lose money and how the Oracle of Omaha actually applies it. When stocks are crashing all around, and even Berkshire's portfolio is down billions, what does this rule really mean to the world's greatest investor? If you've ever heard someone quote Warren Buffett's famous rule number 1, never lose money, followed by rule number 2, never forget rule number 1, you might wonder how that's even possible. During the 2008 financial crisis, Berkshire Hathaway's stock plummeted over 30%, wiping out billions in market value. During the COVID crash of 2020, Buffett's portfolio took another massive hit. So is the world's greatest investor breaking his own cardinal rule every time the market takes a nosedive? Not at all, because for Buffett, losing money has nothing to do with temporary price declines. It's about the permanent loss of capital that happens when a business's fundamental earning power gets damaged or destroyed. This distinction transforms how he views market volatility. Take Buffett's investment in the Washington Post during a severe market decline. While the stock price had dropped dramatically, Buffett calculated that the intrinsic value remained largely unchanged. The company still owned valuable assets, maintained a strong competitive position, and generated reliable cash flow. By focusing on these fundamentals rather than panicked market sentiment, Buffett secured an investment that multiplied many times over in the decades that followed. Think about it like buying a house for $300,000 that later gets appraised for $250,000 during a recession. Have you actually lost $50,000? Only if you're forced to sell during the downturn. If the house remains structurally sound, in a good location, and you plan to live there for years, that temporary price decline means nothing to your long-term outcome. Buffett applies this same logic to businesses. He focuses relentlessly on intrinsic value, the actual worth of a business based on its ability to generate cash, rather than whatever price the market is currently willing to pay. This creates a psychological force field against panic during market crashes. When you ask, does a 30% drop in share price change how many Cokes people will drink next year? And the answer is no. Then you understand that the company's intrinsic value remains intact regardless of market sentiment. This is why Buffett can remain unfazed as billions in paper value temporarily vanish during market panics. What's fascinating is how this principle translates into practical action. Buffett prepares for market crashes by keeping substantial cash reserves on hand. In his 2010 letter to shareholders, he formalized this approach by committing to hold at least $10 billion in cash at all times. But typically, he keeps far more, closer to $20 billion and sometimes much higher. Most financial advisors would consider this excessive, especially during bull markets when that money could be invested elsewhere. For Buffett, however, cash is ammunition. When markets panic in quality, Businesses suddenly go on sale. Having cash ready allows him to act decisively, while others are frozen or forced to sell. It's like walking into a store during a 50% off sale with a wallet full of cash, while everyone else is broke or running for the exits. This strategy paid off spectacularly during the 2008 financial crisis. While most investors watched their portfolios collapse, Buffett deployed billions into companies like Goldman Sachs and General Electric, negotiating preferred stock deals with lucrative terms unavailable to regular investors. How does Buffett decide which businesses are worth buying during a crash? He evaluates them based on their ability to both survive the current crisis and thrive afterward. He's not trying to catch the market bottom. He's identifying fundamentally sound businesses unfairly punished by market panic. Buffett looks for companies with robust balance sheets, sustainable competitive advantages that will remain intact after the crisis, and consistent cash flow generation that can weather economic storms. These criteria automatically eliminate most bargains that catch the average investor's eye during market crashes. This approach reveals something profound about Buffett's never lose money philosophy. It distinguishes between price risk, temporary market fluctuations, and value risk, permanent impairment of a business's earning power. The former represents opportunity. The latter is what Buffett truly seeks to avoid. When markets crash and everyone panics, Buffett asks, is this business still going to be generating cash 5, 10, 20 years from now? Has anything fundamentally changed about its competitive position or long-term prospects? Or is this just a temporary price decline caused by market fear? For most quality businesses, market crashes don't change their long-term trajectory. They just offer a discount on the price of admission. That's why Buffett gets excited during these periods while others panic. He's not breaking his never lose money rule. He's applying it exactly as intended, by protecting against permanent loss while capitalizing on temporary price declines. This perspective transforms how you might approach the next market downturn. Instead of seeing your portfolio drop and thinking, I'm losing so much money, you can analyze what's happening to the underlying businesses you own. If they're still selling products, generating cash, and maintaining their competitive positions, then what you're experiencing isn't a loss in Buffett's definition. It's a temporary price decline that will likely reverse when sanity returns to the market. Buffett's $10+ billion crisis playbook, the 2008 financial crisis case study. The 2008 financial crisis wasn't a disaster for Warren Buffett. It was a once-in-a-lifetime shopping spree. When the S&P 500 was plummeting nearly 50%, Buffett deployed billions into specific companies that would later generate astronomical returns. What did he see that almost everyone else missed? Picture this, September 2008. Lehman Brothers had just collapsed. Financial markets were in complete freefall. CNBC was running markets in turmoil specials every night. Trading floors echoed with panicked shouts. Investors stared at screens of bleeding red numbers, frantically calling brokers. The average investor was either frozen in fear or hitting the sell button. But in Omaha, Warren Buffett sat calmly at his desk, making phone calls, not to sell, but to buy. What makes this period so fascinating is the surgical precision with which Buffett deployed his capital. His $5 billion investment in Goldman Sachs demonstrated this strategic approach. Buffett negotiated preferred shares paying a 10% dividend yield, plus warrants to buy additional shares at a fixed price, terms unavailable to ordinary investors. Buffett continued his methodical approach by investing $3 billion in General Electric under remarkably similar terms. Again securing preferred shares with a guaranteed 10% dividend, he effectively created a custom-designed investment vehicle providing both downside protection and substantial upside potential. These weren't random choices. Goldman Sachs and GE represented critical pieces of American financial and industrial infrastructure. Despite the crisis swirling around them, Buffett recognized their fundamental importance to the economy wouldn't disappear overnight. More importantly, he understood that government intervention would likely prevent these too-big-to-fail institutions from actually failing. The structure of these deals revealed Buffett's crisis strategy. By negotiating preferred shares with hefty dividends, he created a safety net providing substantial income even if the market continued downward. Meanwhile, the warrants gave him unlimited upside potential when markets eventually recovered. A classic heads I win, tails I don't lose much position. But Buffett's most audacious move came in 2009. As television pundits, Still debated whether the economy would survive, Buffett made his largest investment ever, acquiring Burlington Northern Santa Fe Railway, BNSF, for approximately $26 billion, the biggest purchase in Berkshire Hathaway's history at that time. This acquisition revealed another dimension of Buffett's crisis investing strategy. While others obsessed over quarterly economic projections, Buffett looked decades ahead. Railroads represent the physical backbone of American commerce, moving goods across the continent with unmatched efficiency. By purchasing BNSF, he made a generational bet on the enduring strength of the American economy. The BNSF acquisition showcased Buffett's ability to see beyond the economic chaos. While most investors wondered if the financial system would survive the month, Buffett planned for the next 50 years. The railroad purchase demonstrated his core philosophy. Identify essential businesses with durable competitive advantages, then buy them when temporary fear drives their prices down. What ties all these crisis investments together? Each one followed Buffett's systematic criteria. First, he targeted businesses essential to the functioning of the economy. Second, each company possessed strong competitive positions that wouldn't evaporate because of temporary market conditions. Third, all were experiencing what Buffett viewed as temporary undervaluation due to market panic, rather than fundamental business deterioration. The results speak volumes. His Goldman Sachs investment eventually generated over $3.7 billion in profit, a staggering 62% return during a period when many investors still nursed deep losses. Combined with his other crisis-era investments, Buffett's total gains exceeded $10 billion. This was the culmination of patience, preparation, and the courage to act when others remained paralyzed by fear. Buffett's approach differed fundamentally from typical buying the dip strategies. He targeted specific businesses where he could extract favorable terms that ordinary investors couldn't access, rather than simply purchasing broad market index funds at lower prices. Equally important is what Buffett avoided during this period. He steered clear of banks with opaque balance sheets, companies with excessive debt loads, and businesses facing structural challenges. This selectivity demonstrates that Buffett applied rigorous analysis, even as prices plummeted across the board. A crucial element of Buffett's crisis playbook was preparation. Berkshire had built substantial cash reserves in the years leading up to 2008, positioning him to act aggressively when opportunities arose. Unlike fully invested peers, Buffett had financial ammunition ready when prices collapsed. This preparation reflected Buffett's perpetual readiness for inevitable downturns. He didn't need to know exactly when the crash would occur, just be ready when it did. This patient approach, keeping powder dry and waiting for obvious opportunities, contrasts sharply with the constant trading most investors engage in. Buffett's comfort with uncertainty also distinguished him. He invested during the market's darkest days, not waiting for clear signals that the worst was over. This willingness to act amid uncertainty separates Buffett from investors who wait for confirmation that markets have bottomed, often missing the best opportunities. Perhaps most impressive was Buffett's long-term perspective, while others focused on short-term concerns. His BNSF acquisition secured vital American infrastructure that would generate cash flows for decades. This time horizon advantage, thinking in decades while others think in days, creates opportunities invisible to shorter-term investors. What can regular investors learn from Buffett's crisis playbook? While we can't negotiate preferred share deals with Goldman Sachs, we can adopt the underlying principles. Maintain cash reserves for opportunities, focus on essential businesses with durable advantages, and summon the courage to buy when headlines are most frightening. The cash reserve strategy, your financial ammunition. That courage to buy during market crashes is only possible if you've got one thing: Buffett never runs short on cold, hard cash. But here's the twist. While financial advisors tell you cash is trash during inflation, Buffett has stockpiled between $20 to $150 billion over the years. What does the Oracle of Omaha understand about cash that almost everyone else misses? For Buffett, cash serves as financial ammunition, a term that completely reframes how we should think about liquid assets. This offensive firepower waits to be deployed at the perfect moment. When you've got this reserve ready, market crashes transform from scary events into exciting opportunities. Think about what happened in 2008. While most investors were fully invested before the crash with nothing left to buy the dip, Berkshire Hathaway was sitting pretty with a $44 billion war chest. When Everyone else was frozen with fear or forced to sell at the worst possible time. Buffett was shopping for bargains like it was Black Friday. This strategy resembles the savvy shopper who sets aside money specifically for major sales events. While others max out their credit cards on regular-priced items, this shopper can swoop in during the annual clearance and purchase premium goods at fraction of their value, all because they had the foresight to keep powder dry for the right moment. What's truly fascinating is how Buffett formalized this strategy in his 2010 shareholder letter after the dust settled from the financial crisis. He publicly committed to keeping at least $10 billion in cash reserves at all times. Although in practice, he typically maintains much more than that minimum threshold. This was deliberate preparation for the inevitable market panics that others pretend won't happen. Critics argue that holding substantial cash is foolish because it drags down your returns during bull markets. Their fancy charts show how being fully invested outperforms having cash on the sidelines. But what these critics miss is crucial. Emotional resilience during crashes is worth more than a few percentage points of theoretical returns. Picture two investors during the 2008 crash. The first is fully invested, watching their portfolio drop 40% with no ability to buy anything. They're experiencing pure panic. The second has 20% in cash and is excitedly picking up bargains while everyone else is selling. Which investor do you think sleeps better at night? Which one is more likely to make rational decisions rather than emotional ones? Buffett's cash position has fluctuated dramatically over time, showing just how responsive and opportunistic his approach really is. During bull markets, when valuations get stretched, his cash position grows larger. After major downturns, when he's deployed capital into bargains, it shrinks. This is preparation meeting opportunity. In recent years, Berkshire has held record cash stockpiles, showing that Buffett lives this strategy. Even when critics claim he's missing out on gains, he sticks to his guns. His philosophy focuses on being ready when crashes inevitably occur rather than predicting their timing. So what does this mean for regular investors like us? First, we need to separate two distinct cash buckets in our financial lives. Your emergency fund is for life emergencies, job loss, medical bills, car repairs. That money should never be invested in the market. But beyond that, having investment cash, money specifically earmarked for buying opportunities when markets tank, provides tremendous advantage. For regular folks, this might translate to keeping about 10 to 20% of your investment portfolio in cash or highly liquid short-term bonds. This isn't your emergency fund, it's your opportunity fund. It's the money that will give you both financial and psychological advantages when the next crash happens. The psychological benefit cannot be overstated. When you have cash ready to deploy, you actually look forward to market drops instead of dreading them. Your entire emotional relationship with investing changes. You stop seeing red days as disasters and start seeing them as sales. This mindset shift